Welcome back, guys, to another class of options trading. In this class, we'll be learning about how exactly premiums are derived from the instruments itself. So there are a lot of variables that are involved in, making premiums. So in making premiums, in the sense, understand it is a kind of linear regression problem where there are a couple of indicators and the asset. So when the price of asset changes with the couple of indicators, the price of premium moves. It's not like, every 1 rupee increase in the underlying asset will result in 1 rupees increase in premium because, as you saw, there are a lot of strike prices involved in this game. So in the earlier example, if I want to go that when I was giving 5 lakh rupees of token in order to purchase a 50 lakh rupees of shop, so assume that the seller is telling that okay, for 60 lakh rupees, for example, if someone is ready to buy the shop at 40 lakh, 60 lakh, 55 lakh, 65 lakhs, so the token money will be very different with the because the amount is now different. So you can expect, if the price of the shop is kind of he's trying to give it at a lower price, he'll take more token price. If he's selling that particular shop at a very high price, he'll take very less token. So, matlab, I'm just giving you assumptions. So these are the things that can happen. So exactly how these things happens in derivative market, we'll try to understand in this video. So first we'll talk about moneyness of an option. So classification method for options based on their relationship between the strike price and the current price of the underlying asset is called moneyness of an option. It helps traders decide which strikes to trade in various market circumstances. So there are a couple of strike prices. What is moneyness of an option? There are a lot of strike prices. So in Nifty 50, the strike prices vary at every 50 points. So 24,000, 24,050, 23,950, 23,900. These are a couple of strike prices. So you know in order to understand the moneyness of an option, with strike price to trade in various market circumstances, when to go for which strike price to go for option selling, which strike price to go for option buying, and in option buying, if I'm trying to buy a call option, option buying, call option, which strike price to choose, which strike price will give you the most amount of money, and which strike price will eat your premiums very quickly, in the sense you won't make money even if the markets go into your direction. You won't make a lot of money even the markets go into your direction because it may require less amount of money, and the theta, gamma, these things work slightly different in the case of in the money, at the money, out of the money. You'll understand these things. So as I was stating these three terms in the money, at the money, out of the money in the past videos, let's clarify today what exactly it is. So imagine Reliance. Reliance is currently trading, let's say, at 3,000 rupees. We'll check the price of Reliance. You know, so this is my trading viewer terminal, and I'll just go and see what price Reliance is currently trading at. Reliance, I think Reliance is not in the list. Reliance is currently trading at 2,935 rupees. So, what are the different options that are available to me in order to, you know, do a derivative trading into Reliance? So, you have strike prices. So, strike price in the sense the same goes for the amount of money we were trying to predict the shop. How much is the shop ka amount? I'm going to my terminal. How exactly, the prices are defined there. I think Just change the account. So yeah, in this example we were talking about Reliance. So ITC that day we were talking about the current ITC ka price was 486 if I remember on that day, and we were thinking if the price of ITC will go up, we'll make money in the call option. So this was roughly trading at 16 rupees some price, and now it is trading at 19.55 rupees. So in this case, in this, just give me a second. Yeah. In this case, you see, even if the price of ITC went up, how many rupees? 9 rupees up. S- the price of 480C, the call option, it didn't go from 16 to 32. It actually went just 3.55 rupees. So why is it this the case? The reason behind the price of premium going up just 3.5 rupees up is not because that every 1 rupees change in ITC is giving 1 rupees change in the money ITC 480C strike price, because I told you today I'm going to explain you that how exactly there are five things which determines the price of premiums and how it should change. So let's get back to our Reliance example. So Reliance is trading at 2,937 rupees, and there's a call option I added before only, I guess. So, but just you just understand for the sake of example that as the price of asset went up, the price of premiums went up. That day, I think we were thinking of buying this same thing at 26,000, and today, right now, on 9th of August, it is traded at 31,000 rupees. So 5,000 rupees profit. Just predicting that the ITC will go up. I did it in thin air, so don't think that I did anything. Uh, Now let's get back to the topic. 2,937 is the current price of Reliance. So there are, let's see what are the different strike prices that are available for us. 2,937 I'll put. Okay. So you can see there's no strike price such that I'll 2,930. Again, there's nothing. 2,950, nothing. So, what are the strike price difference that you are seeing in the case of Reliance? That there is 2,900. I think after that there will be 3,000 rupees. After that there will be, I think, 3,100 rupees. So the strike price is difference in the case of Reliance. So you can see how it is written. Reliance. This is August. 3,100 is the strike price, and C is the direction. Call European or put European, wherever. If you think that the price of Reliance can go up, so C you'll buy, or if you think that the price of Reliance will go down, P you'll buy. So 3,100, one of the strike price we chose. I'll just remove all these ITC. Okay. And I'll just choose 3,000 as well. Reliance 3,000. So how exactly the strike price itself is decided. They are decided by the market regulators that which stock should be having. What is the strike price difference that each stock should be having according to the underlying current price of the asset. So you can't do anything about it. You just have to check that if you're getting it at the nearest possible point. If you're getting the price at the nearest possible point, you can just go ahead and trade into the security. In case of this, 2,900 rupees, you can see, 38. So if you round off 38, what will be the, nearest point? So if you round 100, you round it according to 100 difference, the round off will come to 2,900. So this will become my at the money. Whatever is the price of the security at any point, versus the same strike price ka contract is called at the money. And what is in the money? In the case of in the money, you will go Reliance 2,800. 2,800 strike price will be my in the money option. So this is same as the September contract itself will be in the money. So yeah, it won't depend on the expiry of the contract. It will only depend on the uh, you know it will only depend on the strike price. Okay, it won't depend on the expiry. So 2,800, be it August, be it September. So you can see the contract which is expiring in the month of August is currently trading at 148 rupees. But when you are going to the next expiry, that today you can buy actually the instrument for the next expiry, September, August. In case of my terminal, so in this case, you will be able to buy September contract, but you think you can see clearly that you're getting it at a higher strike price. Why is it that the case? Because as the this is only about the thing to expiry. If the contract is having a larger time frame to expire, it is just priced more. There's some indicator which is behind this how exactly things works. So in case of Reliance, the in the money will be 2,800 rupees. You can just see in the money matlab, the whatever is the current strike price, less than that will be in the money. Out of the money will be 3,100. That this is called out of the money. That whatever is the price Reliance is trading at, this is 3,000, both of them are out of the money contract. I think you understood by this example. Let me go ahead and so when exactly? So now you understood that these are different strike prices that you can trade into, but what exactly to trade in when you're doing option buying, when you're doing option selling, C, P? What are the different things that you have? What are the different jargons that you have to understand? So this I was talking about in the case of C, call European. In the case of put, the strike price, at the money strike price will remain the same. 2,900 will be the at the money strike price. But in case of put, I'll just show you. So this same contract with the put. Just give me a minute. Yeah. So Reliance 2,900 will P will be my at the money now. In the case of put, you understand what is put all about? If the markets go down, then I make the money. Okay. So the perspective in case of selling will be just opposite of C. So C is exactly opposite of P. Just understand this. Like you'll be very clear that if you understood call options C very very smoothly. So in the case of Reliance, in the case of put, uh, the in the money will be 3,000. 3,000 will be in the money. Reliance 3,000 put will be in the money, and out of the money in case of put will be 2,800. And one more thing I want to tell you that in the money contracts, be it for C, be it for P, in the money will be more expensive than at the money and out of the money. Why is that the case? Because in the money contracts and at the money contracts have intrinsic value, and out of the money contract have has just time value. So what is intrinsic value and what is time value? It depends on the strike prices. So for example, 2,900 put option is having a premium of 37 rupees. So I was telling you about this. This has some intrinsic value as well as some time value. Okay. Why is that the case? So you just figure out the difference between both of them. So 2,900 P is having, what is the premium currently trading at? It's 37 rupees. It is exactly the difference between the 2,937 minus the 2,900. So this contract is having totally the time value. So, 2000, you just minus the 2,937, the current price of Reliance, minus the at the money contract, so you'll get the premium price. But let's say in the case of in the money, so in case of put, the in the money will be 3000 P, as I was talking about. I think you're not getting messed up, right? So now in case of, you see, in the money contract is having more value. So it has, what is the difference between the 3000 and the 2938? Different turns out to be 2 plus 60. 62 is the what? 62 is the intrinsic value plus whatever is left will be the time value of this contract. So, in the money contract has intrinsic value plus the time value, and out of the money value, out of the money, in case of 2800, this contract is only having the time value. There's no intrinsic value as such, because you can see it is currently trading at 13 rupees. Even the difference between the 2938. So this is the market price of my shop, and this is what I'm expecting the shop to be. So this is what I'm betting my shop, that okay, it will go less than 2800 rupees. So when this actually, when the price of Reliance will go down from 2800 rupees, then this will become my then this will become my at the money, and there will be intrinsic value and time value associated with it. I think I'm kind of clear. So again, I'll tell you, in the money option, in case of put, will be having more premium. At the money will be having the same kind of premium. We will be having slightly less premium, and out of the money will be the cheapest. So most of the people in Indian markets lose money because knowingly or unknowingly they are trading in out of the money options. And out of the money options, first of all, they're having more theta decay. They are less volatile, so even if the price of the asset moves, they are not moving, the percentage wise, they're moving like 10-20 percentage compared to the asset, 10 to 50 percentage. In case of at the money option, every 1 rupee change in Reliance will result in half a rupee change in uh, at the money contract, plus the different variables. I'm just talking about one of the variable. And out of the and sorry, and I was talking about the in the money. In the money will be having more. So every 1 rupee change in Reliance will result in 0.6 rupees change in that, or 0.7 or 0.8. So these varies. So in the money options are the best. To give you an overview, in the money options are the best when you are trading into the markets. Let's say Nifty is currently trading at 24,357. Okay. Another example. I think Reliance is too much confusing. Uh, Nifty 50, I'll just add it to the list so that the data becomes clear for you. Yes. So I'll do the list. 24,358 is the current price of Nifty 50. In the case of, let's say, C, to be more clear, Nifty 24,000. What will be my C ka in the money? 24,350 will be my at the money. There is a 50-50 ka strike price difference, as you remember. So 300, 24,300 will be in the money for me when I'm going for a call option. But when I'm going for a put option, 24,300 is out of the money. Now I think I'm kind of clear. Let's say in case of 24,400, Nifty 24,400. So my C will be now out of the money, and my P will be in the money. Right? If at all you are clear with this. 24,000 Nifty 24,350. So 24,350, either the C or the P will be at the money for me. So first we'll talk about only the, yeah, I think I'll just add it into two different lists. Only we'll talk about C in this case. Yes, and I'll make another list for you. Yeah, again, let's start with the call option. So 24,300, 350 is my at the money. So you can see there's some kind of premium associated with it. And this premium is derived from the different variables that we are going to talk about. And 24,400, I was telling you it is out of the money in case of, call option. So you can see the premium is less. 24,300 is the premium of 24,300 is 193. So if I'm going to buy this particular thing, I'm going to require a margin of 4,800 when I'm going for in the money. When I'm doing out of the money, I require only 3,475. So I will capture more momentum when I'm going for in the money. When the price of that Nifty, it'll go from, let's say, 24,360 to 24,400. I'm going to make more money when I'm doing in the money options compared to all of the money options because the variables are different in case of all of those. So, and in case of put, uh, 24,360 is the current, so 24,350 is the at the money option. In case of put, the out of the money option is 24,300. Correct. So 128, the premium is less. So this is out of the money in case of put, and 24,400 will be in the money. So you can just see the premiums 24,400. It's in the money and it is having more premium. So the theta decay as the time passes. The price of premium is a when we say options is a depreciating assets. So why option buying is a depreciating assets or options is a depreciating assets? Because as the time is passing by, the premiums are decaying. And even if you are predicting the markets correctly, sorry, the price of premiums are not into your favor because as the time is passing by, you are losing the premiums. Simply, you are losing the money. So, in case of out of the money, you will be losing the money quickly. To give you a brief, so in the case of this 24,300 put, you'll be losing the money very fast. In case of 24,400, when it is in the money, you'll be losing the money slightly at a less pace because your option is in the money. So when you're putting more money, you just understand this theory. If you're putting more money into something, uh, this is not related to market in general. I'm telling when you're putting more money into something, the chances of that making money is slightly better, and when you're putting less money into something and trading, the chances of you getting successful or making money is slightly less. This is the concepts that work in market. Simple. Now let's get back to the topic. On the fourth slide, I spent so much time. Chalo. So in the money, in the money, to give you an overview, there's a call option when the spot price is higher than the strike price. Put options when the spot price is lower than the strike price. I think you got it. In the money, call option is when the price of that security, the strike price of that security is less. That is called in the money. In case of put, when the strike price is greater than the spot price, whatever is the current market price is called spot price. From now, I'll be mentioning this term spot price, not current price. So when the price of when the strike price is greater than the spot price, that is put option in the money. When the strike price is less than the spot price, then it is call option ka in the money. So more expensive due to intrinsic value. I was telling about in the money, you will be paying more money, and there's higher delta. There's a greater sensitivity to price changes in the underlying asset. So if the price of Nifty goes up 10 points when you're buying it in the money option, there's a possibility that you'll make much more money than the ones who have bought at the money options and the ones who have bought out of the money contracts. So call option at a strike price of 8,000. If the something is at currently trading at 80,070, the in the money in case of call option will be 8,000. In the case of out of the money, the strike price will be 8,100. I think I am crystal clear. At the money, both calls and put option have the strike price. approximately equal to the connect spot price. So in case of Reliance, we were telling that 2,900 is the at the money price, even for C, even for P, because it is the nearest possible price when you are comparing the spot price of the Reliance. So it is balanced risk and reward. It's ideal for strategies involving volatility. So majority of the people will either trade into at the money or in the money. But when you are kind of hedging a particular position, people go for out of the money contracts because they are much cheaper and the risk to reward matches when you are hedging a position. So we'll talk about hedging later, but to get you the concept very clear, when you are simply trading, you are going to trade in at the money or in the money. You're not going to trade out of the money because your premium is going to go much faster even the market moves. You're going to make less money even if the market moves. Call and put options ATM, strike price of 80,070 and spot price. The strike price is equal. So let's say you're getting the strike price of 8,070 in case of when the spot price is 8,070. We were not getting the strike price same when we were trying to trade Reliance. So that's why I checked 2,930. Is there any at the money option? So that'll be my at the money if there is something, some strike price, some derivative contract of 2,930, because the price of Reliance at the time we were checking 2,937 it was. Now comes out of the money when the spot price is lower than the strike price, when the spot price is higher than the strike price. It's cheaper due to no intrinsic value. So intrinsic value, that means the contract itself is not having any kind of value. It's just that the time there's a thing of time ka value that is associated with the out of the money contract. So there's higher risk and higher rewards. Potential for significant gains if the underlying assets moves favorably. So if so for example, you have bought an out of the money contract, even though you know there's more risk associated to it, and the chances of you making loss is potentially on a much higher side. But when you know the momentum is kind of short, so you know that the markets are going to crash. Let's say you crash in the sense like 20-30% down. You think that there's some kind of devastation that is happening out of the around the world. There's nuclear war or there's some kind of war that is happening. Let's say the India is having civil war, or Pakistan attack, China attack, or Bangladesh attack, or any kind of attack. So if you think that the situation is drastically wrong, you can go for out of the money contracts because you are going to mint a lot of money from out of the money contracts if the underlying moves into your direction. Simple. So in the chart, we'll try to teach you the intrinsic value. So at the money split, 100 is the strike price. So call option ka intrinsic value, call option has $5 ka intrinsic value when you are, so call option in case of this will be 95. Call option in the money, put option out of the money. Call option out of the money, put option in the money. So it's talking about the different strike prices. So when you are trade when your price of the stock price is at 95 rupees, the 100 rupees will be put option ka so the 5 rupees whatever you that in the money, so you understand 100 will be in the money in this case, so 5 rupees will be the intrinsic value of that contract. When in case of when if the strike price is at, if the price of the security is at 100, the call option will be 95, so 5 rupees itself will be the intrinsic value. When you're talking about the 105 rupees strike price, 100 will be what? In the case of call option, the 5 rupees will be the intrinsic value. So I think I was clearer with that example more. Okay, how exactly in the money, out of the money, at the money, things have different strike prices and intrinsic value. So the ones will be having the more intrinsic value will be in the money. The ones who will be having zero intrinsic value will be out of the money, because you can see the price of premiums are much less than the difference between the spot price and strike price. So if there is a huge difference between the strike prices, and still the amount of premium that you're giving is very less. In the case of in the money, it'll be opposite. If the strike price difference is something, you'll be paying actually more premium. Difference between the strike prices plus this time value associated. So the difference between the spot price and the strike price in case of in the money will be your intrinsic value. Simple. Deep in the money. So deep in the money is spot price significantly higher than the strike price, and spot price significantly lower than the strike price. Again, we'll go to Allies Blue and then understand. Nifty is currently trading at 23,344. What will be deep in the money in case of call option? So in case of call option, either you're doing, option buying, and let's say, so Nifty 24,300 will be deep in the money. Wait, sorry. 24,344. Sorry. 24,000. 24,000 will be deep in the money. 24,003 will be at the money. Or sorry, in the money. 24,300. So 24,000, you can see the more deep in the money contract that you will choose, the more premium that you have to pay. So actually, it will require you to pay 10,000 rupees for a call option when you are, trading deep into the money. But when you are trading at the money, you require just 4,000 rupees. That's the difference. And plus, you can see the difference between the 24,000 level and the to 24,348 level. So what is the difference comes out to be? The difference comes out to be 350 rupees oddly right now, right? So 350 should be my premium rate, but we are not talking about the at the money contract. We're talking about the deep in the money contract. So the intrinsic value in this case will be 350 rupees. The extra 55, what you are seeing right now, is the time value of this contract. So the time value of this contract is right now at 50 rupees, which is much higher, right? So this is called deep in the money. What will be in case of what will be the deep in the money? The deep in the money, let's say, will be 24,800. 24,800. Let's see the premium of 24,800 put contract. So you can see the premium is 462 rupees with the same, with the same expiry. So 14th August will be the expiry date for whatever for these contracts. So 24,340 is the market price. So what is the difference between the 24,800 and the current price? It'll be somewhere around 550 rupees, if I'm not wrong. 50 plus 450 rupees, sorry. So 12 rupees is the, so if it is in the money, there's an intrinsic value associated plus the time value. The intrinsic value associated is 450 rupees and 12 rupees is the time value of this contract. So I think deep in the money is clear. Now deep out of the money will be the same, just that the opposite things. So deep out of the money in case of this will be, let's say 24,000 will be deep out of the money, or 24,000, 23,900 will be out of the money in case of put option. And in case of call option, 24,800 will be deep out of the money. So just compose it. That's what I was trying to. If you understood the C part, you'll understand the P part. Again, we'll go to the deep in the money. Yes. So spot price significantly lower than the strike price. So I showed you, right, the spot price of Nifty was significantly lower than the strike price. So 24,800 was deep in the money in case of put option, and the spot price is very low compared to the strike price we were choosing. In the case of call option, the spot price is significantly higher than the strike price. So 24,350 is the current Nifty level. We were choosing 24,000. So the spot price was very high compared to the strike price. Simple. Deep out of the money, again, a reverse concept. Spot price significantly lower than the strike price. So, 24,300 is the current level. We are choosing somewhere around, let's say, 29,000 call option. That'll be deep out of the money. In case of put options, if you are having a view kind of like that the markets are going to be like this at some point of time, so you can choose expiry which is 3 months down the line, pay a higher premium, and if the market moves actually into the direction, you are going to sit on a very huge profits compared to the ones who are doing intraday on an everyday basis. So if you have the view in mind, if you have the analysis in perspective, you can choose deep into the money, deep out of the money options, and which requires significantly higher capital, but the risk to reward, if you have the same kind of risk to reward, if you have the bear call spread or a bull call spread, how exactly straddle, strangle, there are a lot of strategies that you can develop over time. Okay, what are the things that you can trade into market, and how exactly to make money in different situations. So when exactly the markets are not going anywhere, they're consolidating, you can do option selling. When the markets are giving huge directions, but you don't know from which direction, you can buy both the call and the put at the same time. And if the markets move into one percentage, either up or either down, one of the premiums are going to be super low, but the other premium will be so much profitable that overall you will be in much more profits. So there are a lot of strategies that you can develop, understanding options and understanding market behavior in general. So coming back to the topic, very low probability of being profitable when you're deep out of the money, and very cheap premiums. When you're the deep out of the money will be like so cheap, deep in the money will be so expensive. When you're going out of the money, things are very cheap. When you're going deep into the money, things are very expensive. Let's talk about option Greeks. So all these things, all these bakwas I was telling about, oh, how the 1 rupees price of underlying changes, 0.5, 0.4 rupees changes in premium, and at the money, out of the money, in the money. How exactly these things are changing with time and with a lot of variables involved. So these are called option Greeks. So option Greeks are financial metrics that describe the risk and potential returns of an option position. So when you have, these things, if you are keeping it into mind, and you understand delta, you understand gamma, you understand theta, vega, you will be in a better position to choose which strike price I have to choose when I am doing a particular trade. And if you're trying to make a bigger position, things are very calculative. So this is a lot of mathematics is involved in doing all of this, but it is very simple concepts. So if you understand it once, you will understand it for lifetime, and you won't be having any problem understanding derivative in general. And the derivatives are in the bond market. If you're just thinking that this is not the kind of thing that I want to learn and blow up my mind in, this works in currency, this works in cryptocurrency, forex, bond market, stock market. So there are, all the markets have derivatives, and all the derivatives have the same thing, or have the same things working. The delta, gamma, theta, vega, everywhere this is same. So understanding it once will be very helpful in your future. Will be very helpful in your future if you're trying to, make money, make a living out of options trading. Delta. First option Greek. Delta measures the rate of change of an option premium based on the directional movement of the underlying asset. So a call option have a positive delta and a put option have a negative delta. You'll just question that why is it the case that the call option is having the positive delta and put option is having the negative delta? Because when you're making money in the put options, when the price of underlying is going down, right? So the delta needs to be negative when you, so how exactly, the calculations are working. If the price of underlying goes down, your portfolio should be in profit if you are into a put option buying, let's say. So the delta helps you in measuring the rate of change of an options premium based on the directional movement. How much the price of a underlying is moving compared to how much the price of an option is changing is covered into delta. So delta between 0 and 0.5 will be out of the money option. So I was telling you that even if you are trading into out of the money options, you'll make less money. Why is it the case? Why is it that the case? The case is because of delta. It's having low delta. So even if the price of security moves, let's say, just assume that delta is the only variable that is affecting the premium. First assumption, I think I'm clear. Delta is the only variable that is making the option premium price move. So out of the money option in case of delta will be 0 to 0.5. So matlab 1 rupees change will be resulting in 0.2 rupees change in your, so 1 rupees increase in Reliance when you are out of the money option. Even in PEC that you leave, you'll make only 0.2 rupees. You'll make only zero point 0.3. Either you'll make 0, either you'll make 0.5, but not more than 0. At the money option, will be having a delta of 0.5. So every 1 rupees change in Reliance will result in 0.5 rupees change in option premium. If you are going C, 2,900, current price of Reliance is 2,937. Let's not deviate from the example. Let's assume that the price of Reliance moves to 2,950. How many points up? 13 points up. At the money option will make you how much money? 6.5 rupees. So 13 rupees change in underline will result in exactly half a rupee per point ka increase in the case of premiums when you're doing at the money, be it in CP both. Let's talk about in the money thing. Delta between 0.5 and 1 will be in the case of in the money. So every 1 rupee, let's say there's 1 rupee ITM or 1 delta in the money. So you're deep in the money. Call option, you have bought 2,800 C. Huh? 20,000 and 29,037 is the current price of Reliance. Let's assume that 2,937 went to 3,000. So what is the price of premiums that changed? 63 rupees change in underlying will result in 63 rupees in the change of premium. So exactly you're getting how the price of underlying changed to 63 and the price and the premium what you bought 2,800 C exactly it moved to 63 rupees up. In the case of ITM, it varies from zero. So there's a range associated with out of the money and in the money. It's not exactly hard code 0.5 or 1. It's 0.5 and 1. So it can be 0.5, 0.6, 0.7, 0.8, 0.91, and it changes with the underlying going up and down. So one more addition that I want to put. So if the Reliance 2937 2937 went, so the in the money option was at this time was 2,900. If the price of Reliance went to 3,100, so what do you think will be the in the money now? 3,000 will be in the money now. At that time, when Reliance was trading at 2,937, 3,000 was out of the money. But when the underlying, so as the underlying moves, the strike prices change in the money, at the money, out of the money, in the money, at the money, out of the money. So with that, delta also changes, gamma also changes, vega also changes, theta also changes. So these are the calculations that work behind. So if in this video we're just going to talk about the calculation. So if you're not very much interested in learning that how my premiums are going to change when my underlying is going to change, this video is not good. This video is not for you. You can just actually go ahead and skip this video. But if you're interested, then when exactly I'll make money and how much money I'm going to make when I'm buying a particular strike price. This is the video that should be right fit for you. So it increases the delta behavior increases from out of the money, at the money, in the money. Understood the graph? Out of the money, at the money, in the money. So the best is in the money when you're talking only about the delta. It's moderate. There's no up good or bad. Delta 0.5 straight. Out of the money is 0 to 0.5. So the worst scenario for you is out of the money, as I was talking about. But when you have a bigger picture in perspective, out of the money makes the most money. Out of the money options makes the most money. Why is it that the case? We'll talk about later. So I think in the case of call option, 0 to 0.5 will be my call option ka out of the money. When I'm talking about the call option at the money, 0.5. When I'm talking about the call option in the money, it'll be 0.5 to 1. What in case of course, just put a negative. So, matlab, for a clearer picture, it works exactly the same. Just because the negative signs comes into picture, because what you're trying is to short the markets. So, put is shorting the markets, and shorting the markets comes with the selling will come when you're doing option selling. It will come minus 25, minus 50 quantities. So you'll think, why is there a minus 50 in my account? So why is the minus 50? Because as the underlying is going down, you're making the money. Simple. So 0 point negative, so the in the money varies from negative 0.5 to negative 1. In the case of put at the money, it is just negative 0.5. And in the case of put out of the money, it ranges from negative 0.5 to 0. Practical example of delta. Nifty spot price is currently, so spot matlab current price. Nifty spot price is currently trading at 8,125. What you are holding is in the money 8,000 CE call option in the money, what I'm holding. So I just told you that in the money option will be having a more amount of delta. So 0.7 in this scenario, 0.5 to 1 was the case we were trying to take. So, position delta calculation will be every 1 rupee change in the underlying in the Nifty will result in 0.7 percentage move in the premium when I'm holding this 8,000 C. What will be the case of at the money? At the money, let's say Nifty is trading at 8,125. Holding is 8,120. So this is, you can see it's clearly at the money option. So 0.5 will be my delta. 1 rupee change into Nifty will result in 0.5 rupees change into my premium. So we are putting all of this into perspective, assuming that delta is the only Greek that is affecting the option premiums. But if you will broadly understand all of this, delta is not the only Greek that is affecting. There are multiple Greeks that are affecting the option premium at the same time, and on real time it is calculating the premiums. So the model I was talking about, the Black Souls model, was the one which gave the calculation that okay, these are the variables, this is the change, and simultaneously the premiums, derivatives, it is how exactly it should be defined, or the money option. So 8,125 is the current spot price of the Nifty. 8,200 in the case of call option will be out of the money. Okay. Delta is 0.3. So every 1 rupee change into Nifty 50 will result in 0.3 rupees change in my option premium. So this is about the example. Just a second. Adding up deltas. So now the thing comes is now adding up delta. Now which how this adding up deltas emerged from in somewhere in the well, adding up delta means I was talking about the positive deltas, the negative deltas. So when you add a positive delta and add it with a negative delta, will result into zero delta, or delta adding up, or when you're talking about the positive delta 1 plus positive delta 2, there'll be a total delta of 1. So assume you have two ATM options. Both will be having 0.5 rupees delta. So 0.5, 0.5 delta. So the total delta will be 1. So every 1 rupee change in the underlying will result in actually 1 rupee change into your premiums. And you're only talking about the delta. Let's say you have a call option and a put option at the money. This is called straddle in the case of one of the strategies straddle. When you don't know where the markets are going to go, you make a straddle, and if there's you add up the total premium of C plus P, and the markets have to move more than the total premium that you have paid in the case of straddle. If the markets move up more than the amount of premium that you have paid, so 200 200, assume 100 was the C and P ka premium in yesterday's video. So 200 was the total amount of money that I was paying for both C and P. So a positive 0.5 delta, a negative 0.5 delta will make a delta of 0. That is called delta adding up. So it's a delta neutral strategy when it is a long straddle. So if the markets move up by let's say 500 points, or if they go down by 500 points, I make profit. Why is that the case? Because one of the premiums will actually, tends to zero, but the other premium will be, let's say, 400. So 200 is the total amount of money that I paid. 100, the 100 will, let's say, it becomes zero. But the other 200, it becomes you get 200 to 400. So totally, how much amount of money that I made? 200 points I made because the markets moved actually 400 points and I paid a total premium of 200 rupees. So that is one of the delta neutral strategy where adding up deltas logic works, and you can use delta adding up logic anywhere. So if you have many options, you can add up the deltas. You can clearly see the delta. What is the so where you'll get all of this data? You'll easily get all of this data on internet. There are a lot of websites that give you, I think, including NSC, which gives you, delta, all these, how this Greeks, what is the Greek of any spot price, strike price, and uh, there you can analyze and go ahead and do the calculations, what exactly you need to buy. Let's go into the next slide. We have an example of Infosys where I am doing a long at the money call and long at the money put. As I was talking about it, long straddle, right? So I'm buying a at the money call option. I'm buying a at the money put option, and the delta of zero point 0.5 and negative zero point 0.5 will make it a delta neutral strategy. And I was talking about the long straddle in this case. Okay, the volatility, the delta won't be changing. So every 1 rupee change in the underlying will actually result in zero rupees change in my both additional premiums, because when I'm making 0 0.5 rupees in call option, I'm losing 0.5 rupees in the put option. So that's why I'm making zero money. So you'll think that, if you're making zero money, that how you'll make money in the long straddle? Uh, because if the underlying will move into one particular direction very heavily, I'm going to lose all my money if the underlying sticks to the same price. So, but if it moves into one particular direction, one of the long at the money call or long at the money put, option buying C, like option buying P, one of them will become in the money. So let's say if the markets move down, so 24,350 call, 24,350 put, and market is at 24,350. The markets went down from 24,350 to 23,000. So my 24,350 put will now become in the money option, and my delta, what was in the case of minus zero point 0.5, will no longer will be minus zero point 0.5. It will be like 0.6, 0.7, 0.8, or 0.9. Or if the markets move up, like let's say from 24,350 to 27,000 in a day, or till the time I'm holding the call, let's assume. So the 24,350 call will become in the money. So that's how you make money in long straddle.